I was trying to decide what that music was doing. I guess that was our segue. Thanks, Con. It's really a pleasure for me to be here, and you know, I do go back a long ways with Con. He was an attorney at the Federal Reserve Board, a senior attorney at the Federal Reserve Board when I became appointed to the FDIC, and then he left shortly after I got in town and went up to New England, where he was general counsel of a bank holding company. And then when I left the FDIC about 8 years later, I formed a consulting firm, the Secura Group, and which I sold a few years ago. But one of my first steps at the Secura Group was to reach out to Con and ask him if he could join the firm and open an office for us in Boston, which he did. And Con and I have a lot of debates over the years about, I don't know which mic is on. Is it this mic? No, it's this mic, okay. Con and I have a lot of debates about a lot of issues, and I have nothing but respect for his intellect and his integrity. So when he called me to ask if I would come and talk today, I agreed to immediately. I think he asked me yesterday afternoon, as I recall, but and anyway, he also didn't tell me what I should talk about. So I came up with a topic that deals with a problem that I think it's been a serious problem, and one that's been on my mind a lot lately. And when I was listening to the panel discussion, it all rings so true. We got a really big problem in this country, and it's very few people, a relatively small proportion of our population qualify for bank credit anymore. They can't. They're subprime, or they don't. They either have a low rating or they don't have a rating. And banks have become very different than when I was a kid growing up in a small town in Ohio. There was during that period in the 1950s, we had a very large and growing middle class, and it was constantly people were constantly moving up and up through the economic system, and I think having a large and upwardly mobile middle class is just critical for democracy in particular. And I really fear that our middle class is in a state of decline, and I don't know where it ends. But Pew Research defines the middle class as people with annual household income ranging from $47,000 to $147,000, which is about 51% of the U.S. population fits into that category. You got another 20 or 25% that are below that. And so when you talk about the percentage of our population that's is in prime credit, has a prime credit rating, it's maybe 30% of our population. And the banks, because of actions by the bank regulators, have really been discouraged to serve that group, the subprime group. It's very, very difficult for a bank to do that anymore, and we really need some changes in attitudes on the part of the regulators. I think that instead of having a thriving core of Americans that are defined by stable jobs, increasing household income, upward mobility, and solid savings, today's middle class is living largely paycheck to paycheck, with less than $400 in savings on average. They seem to have no appreciable gains in household income for the past decade or so, and they experience very high levels of income volatility. During the past 2 decades, banks and other creditors have developed and have started to rely upon automated scoring systems for granting or denying credit to consumers and small businesses. I recall when I was in law school many moons ago, and I didn't have enough money to get through my senior year, and so I went to a bank and tried to borrow the money, and I got it, and it was a bank in Ohio, and To this day, I remain grateful to that bank for providing that money that helped me finish my senior year in law school. But that's awfully tough to do today, I guess, other than government supported student loan programs. But it used to be that the banking system, particularly the smaller community banks, would take care of those needs in their communities, and they didn't need to see a credit score. I didn't have a credit score. I never borrowed money. How could I? And so I think that we've really got a very different banking system and financial system today, and we got to figure out a solution to it, because we can't leave half the population out of the economic system. In earlier decades, most loans decisions were made by individual loan officers. A review based on a review of bank statements and trying to assess your income and your future prospects and your connection to the local community. But that has been lost, and we've got to figure out how to fix it. To regain the trust and the business of Middle America, bankers and their regulators must encourage innovations based on understanding the needs of the underserved Americans. With new leadership coming soon at the federal banking agencies, I don't know what soon means anymore. The confirmation process is rather extended. I don't think I would have made it through it. But in any event, we do have new leadership coming into the banking agencies, and I really would like to offer 5 insights into things that they need to be thinking about. And the first one is that America is now a non-prime nation. I don't know what it was when I was becoming an adult, because we didn't really rely so heavily on models and formula, but clearly today we do rely on them. And if you don't have a prime credit score, you're in trouble in trying to deal with, be a part of the economy. 2/3 of Americans now have a non-prime credit score or no score at all. Due to the high credit score requirements, as many as 160 million Americans will find it difficult or impossible to access traditional bank credit. Stop and think about that. 160 million of us can't get credit from the banking system. If I were still a regulator, that would really be a focus of my attention. I mean, we simply must fix that. America can't survive that way. It's going to be a very different country if that continues much longer. The way for banks to grow and better serve their communities is to figure out how to lend again, safely and profitably, to a much broader range of customers. That's the big challenge in our banking system. They've got to learn how to lend again to a much broader range of customers. And the bank regulators have got to learn how to be comfortable with that and not tell banks they can't serve this marketplace, which they've told them. I mean, you had 4 banks that were thrown out of this field in a very visible way: U.S. Bancorp, Fifth Third, Wells Fargo, and Regions. The regulators told them to get out of this field, and that message is still ringing in the ears of all the other banks. Secondly, non-prime customer needs differ greatly from prime customers. Traditional bank credit products haven't really changed much in recent decades. Banks assume a customer is willing to come to a branch, fill out an application, provide paperwork, and then wait for a decision. Non-prime customers' need for credit is far more urgent than a prime customer. According to research from the Center for the New Middle Class, the top 5 reasons for selecting a lender are: solve financial need, fast and easy, money quick, no hidden fees, and few documents. That's what the new middle class wants, and it's not what the banking system is providing. Interestingly, lowest APR was listed as a top 3 reason for selecting an institution by less or fewer than 1 out of 5 non-prime customers. Only 1 out of 5 cared about that. It's not enough to provide credit for customers' immediate needs. Banks should be fully committed to improving the financial wellness of their customers with credit building and financial wellness tools and training. You got to teach people how to be good risks for a bank. 3, traditional underwriting approaches don't work. Although FICO scores do a good job of identifying the overall riskiness of customers within different bands of credit scores, they are only minimally predictive of underwriting for non-prime customers. Prime lenders look for customers with pristine credit and typically turn down anyone with limited credit history or derogatory credit information. Nearly all non-prime customers have some sort of problem with their credit. Nearly all. It takes new targeted credit scores built around specific types of non-prime consumers, often using alternative data sources and machine learning techniques. Regulators should support technology-based innovation in underwriting. 4, non-prime lending can be less risky than prime lending. The real risk in consumer lending relates to changes in the economic environment, and perhaps surprisingly, this is where non-prime lending is actually less volatile. According to information from the credit reporting firm TransUnion about personal loan performance volatility under several periods of financial stress, the prime credit risk score ranges showed much higher variations in charge-off rates than non-prime scores. Subprime customers are simply accustomed to making more adjustments in stressful times and make those adjustments more quickly. 5, fintech innovators are not the enemy. Banks have long relied on technology partners to support innovation. Most banks utilize third-party technology solutions for their branch systems and for support of their core products. Fintech innovators should be no different. Banks have funding and compliance advantages, and banks already have financial relationships with the majority of Americans. However, most banks will have difficulty matching the agility and analytical savvy of the fintech industry. Regulators should be receptive to joint ventures between banks and technology firms. An outdated regulatory environment fueled by misperceptions about non-prime lending has resulted in greater risk for both banks and their customers. Banks are being weakened by losing market share and profitable sources of income, and consumers are being driven to more expensive non-bank lenders. The incoming leadership at the federal banking agencies has an opportunity to help banks reemerge as the lender of choice for tens of millions of working Americans. I really appreciate the opportunity to be here, and I'm told Con I didn't want to talk too long because I really would like to do some Q&A, and this is important, really important message I'm giving, and we've got to together find a way to fix it, and I'd love to have some back and forth. So thank you very much. Who wants to do this? We'll throw you the box.
I'll start, John.
Okay.
I can even grab the box. So it would seem like if we could leverage the Community Reinvestment Act, CRA, from the standpoint of making these partnerships look good to a traditional bank. If the regulators could understand that the technology, as you put it, firms are serving communities or persons that the Community Reinvestment Act is supposed to address that maybe traditional banks are not doing as well with, that partnership could work for both. But it seems as though the federal regulators don't want to hear that message, or they don't want to try hard enough to understand how the impact is and who's being served. Have you heard that at all? Is there a way for us to help address that?
I'm not sure I understand quite what you're hearing on to the contrary, but I can tell you that I recently went into a meeting with the OCC, and I'm told there are 10 of you hiding in the audience somewhere. But I went into a meeting with a fintech firm, and it was a wonderful meeting. It was over an hour of exchanging of views, and there was genuine interest. And then the next day, or maybe later that day, we actually went over to the FDIC and had a similar meeting. And both agencies seemed very receptive to finding ways to bring technology partners into this and enable the banks to better serve the public. It's just not acceptable that half of the people in this country, 2/3 of the people in this country, are not qualified for a bank loan. And that just doesn't work. We've got to fix the system. A college kid ought to be able to go into a bank and get a small loan. I did. And certainly people who are experiencing hardships in their life ought to be able to turn to their banker and get some help. And I think that it may be hard for the banks because they have the expensive branch system and they are in probably better neighborhoods. They're not always in the neighborhoods or small towns where the people are that need credit. So it may be hard for banks to play this role alone, but surely they can partner up with technology firms that can help them figure out how to do this in a cost-efficient way. For example, you don't really need to do it through a branch system. You could do it online, and I don't think very many banks would be very comfortable, or the regulators would be very comfortable with the banks doing that right now. But I do think that the FDIC, based on my conversations, I believe the FDIC and the Fed, and the FDIC and the controller, and probably the Fed, would be very interested in having these kinds of conversations. As I said, I've had some of these conversations that were really well attended and a lot of substantive discussion, and there was genuine interest in how we make this happen. If you're not worried about America with half the people in the country not being qualified for bank loans, you ought to be.
Hi. So I have a question, a follow-up on that. Do you think that companies that are not fintech companies, maybe that are not primarily financial companies, should also be allowed to get a charter? There's been a lot of talk about the separation of banking and commerce, and should that be reevaluated today?
I understand the basic question you're asking is the banking and commerce issue. I'm having a little difficulty understanding what kind of firm you are suggesting.
Sorry, I meant a tech company that's engaged in financial activities, but that's not primarily financial, maybe? That has a commercial business lines.
Well, we have separated banking and commerce in this country since 1956. The Bank Holding Company Act was enacted in 1956, and by the way, I wasn't a regulator at that time. That was a bit before my time, but that's when we put in place the separation between banking firms and commercial firms. A lot of people would have you think that, in fact, sometimes when you're talking to regulators, they seem to think that that was in the U.S. Constitution or in the Ten Commandments or whatever. This is a relatively recent thing that we'd separated banking and commerce in this country. I guess it's okay that we have, but we did allow an exception for one bank holding companies. We forbid commercial ownership of multi-bank holding companies, but not if you only had one bank, and that was changed in 1970. So that's a really recent thing. Until 1970, commercial firms, car makers, whoever, could own a bank. And now that you have nationwide branch banking, that would give you coverage of the whole country if they could still own a bank. So I guess what I'm telling you is that we shut that down relatively recently. Over the course of my career, I started my career in 1969. In 1970 is when we decided we were going to close the loophole, that it was called, for one bank holding companies. It wasn't a loophole, it was intentional. But we decided to prohibit that in 1970. And there still are exceptions to it. For example, the Industrial Loan Company out in Utah. And there are all sorts of commercial companies that own industrial loan companies, and they do business nationwide. I was on the, hello there, young lady. How you doing, Joanne? Good to see you. I've been on the board of a couple of these ILCs. One was owned by American Express, and I was on. It handled all their credit cards, and I was on the board of that industrial loan company it was called American Express Bank, and so there's still a lot of avenues that we can use to get commercial firms into the business. It's tough because the bank regulators are very suspicious and they're going to have some very high standards, but it can be done, and it is being done, and it will continue to be done. Nobody's been able to close that final avenue, the industrial loan company, yet. And I hope they never do, because I think it really has allowed for the creation of some really good competitors in the field, and I'd hate to close that down. I basically am in favor of lots of competition. I think competition makes us all better, and so I don't like rules that shut down competition just for the sake of shutting down competition. If you really got a policy concern that somebody might do something wrong, fine, deal with that. But don't tell the whole world that you can't be involved in banking unless you are organized in the traditional fashion and you have the traditional banking sort of business. I do think we must enable this industry to change, to keep pace with the economy and what's happening in the economy. And somehow the banks have got to learn to be able to learn to partner up with people who can really help them serve the public better. We're not doing it right today. It's not acceptable to have half the people in this country outside the banking system. That's just not going to work. We're in for a heap of social problems if that continues. Yep.
So given your comments, how would you propose to address, if not sort of chartering fintech companies as sort of bank alternatives, to deal with the significant reduction in number of branches in rural areas? Banking seems in many small communities not to exist anymore, and I think fintech companies, some of which are in this room, are helping to fill that gap. Would you support that, promote that? Otherwise, how would you expect banks to rebranch? Because I don't know if, as a business matter, that will make sense for them.
Well, I don't know. That's a good question, and I don't know that rebranching, to use that terminology, I'm not sure that's the answer. I'm not sure the banks need to put a branch there. It might be nice if they could. But you certainly don't need as many branches going forward as you've needed in the past. And if you had a branch in a smaller town, that might be sufficient if you combined it with other forms of delivering the product, such as online and all that. And I think that I don't have a problem with a fintech company being allowed to own a bank and operate a bank. Maybe an ILC, maybe a traditional bank. I don't know that I have a problem with that. I do think that they ought to have to go through an approval process the same way anybody else would go through. I mean, the banking agencies do a pretty close investigation of you if you want to start a new bank, and I think that's appropriate. I think they need to have approval over how you're organized, what your business plan is, whether they think it'll work or not, what controls you have in place to make sure that you're following the law and the regulations. What kind of a board of directors do you have? What kind of management are you proposing? I mean, I think all those things are highly relevant. They're asked of anybody else that wants to start or buy a bank. Why wouldn't they be asked of a fintech firm? I think, and I don't think the fact that a firm is got some extensive experience in technology, why would that make them ineligible to buy a bank? I mean, banks are a large part of what a bank does is it runs technology, and you couldn't have a banking system if we didn't have really good technology in it. So why not a technology firm? Where you get into trouble, or at least a lot of controversy, is, for example, if Walmart wanted to buy an industrial loan company, that raised a lot of concerns throughout the banking industry that Walmart would be so powerful that they'd wipe out the community banking firms. And I understand that concern, and I think we need to be sensitive to it. But if you've got, and so if Microsoft wanted to create a banking empire, I'm not saying it would, but if it did want to do that, I think that would raise political questions. And what kind of concentration of economic power do we want? And so that would be debated. But if you've got a relatively small technology firm, and they want to organize a bank, and they've got highly qualified people who are doing it, I don't have a problem with it. I think that they ought to be able to. They ought to have to go through the same hoops that everybody else goes through, but it shouldn't. It's not a problem in my mind. Did I see a hand over here?
Yep. Sorry, one question.
Oh, sure.
Over here. Thanks.
Last question.
Yep. So let's swap one of those names from Microsoft to Amazon. So Amazon was recently named as the largest competitive threat by major banks over the next 10 years. So if Amazon came and decided to, I don't know, buy Capital One, as it was rumored at one point last year, or decide to launch its own charter because it has technology that does face recognition as a way to confirm a transaction, do you change your point of view on whether or not you think that's a big threat to the community bank? Isn't Amazon just like Walmart in that scenario?
No, I didn't think I would have to change my view to answer your questions. I can't see you very well with the lights in my eye, but I think that Amazon doing that would raise a lot of the same controversies that Walmart raises. And you're going to have a whole bunch of banks, community banks in particular, but even some larger banks, I suspect, would be very concerned about that and say that that's not appropriate. We're going to have way too much concentration in our economic system and so forth. And I think that kind of issue needs to be resolved in the political arena. I mean, if I were chairman of the FDIC, I'm not sure I would act on that application, because I think I would say, I don't think that's what Congress has ever intended to do with the banking system. I don't know that they would be opposed to it, but we ought to play that one out in the political arena. It shouldn't be me as a regulator I really have a term of office. I don't have to be elected or re-elected. I shouldn't be the one making that decision. That should be made in the public arena, and because it really could have a profound effect on the structure of the financial industry in this country. So I would kick that over to the political arena and let them decide it there. And I don't know how I would argue about it. I mean, I might join either side of that debate, because I can see some real negatives of it, and I also can see some positives. I think it's a tough decision that we may have to make here one of these days, but we don't have to make it right now. What we have to make right now is the decision of how we're going to deal with 60% of the American public that cannot qualify for a bank loan. That is an immediate problem, and it must be resolved. And if the only way we can resolve that is to get Amazon in the banking arena, then let's do it. But I don't think that's the case. I think we can do it right now by letting the banks start experimenting with this, stop throwing people out of this business, try to draw them into this business. I didn't like that they threw 4 banks out of this business, serving these non-prime customers. Those banks were trying to find a way to do it, and they should have been applauded for that and encouraged to try to find ways to make it more, make the rates more competitive and and more user-friendly and so forth. I think that we ought to be encouraging banks to figure out how they can help solve this problem. It's just not acceptable to leave that many people out of the banking system, and it won't work in this country. Thank you very much.
Thank you, Bill.